Millions of seniors are overpaying Medicare in 2026. Check these 3 hidden charges today. Right now, millions of Americans on Medicare are paying more than they legally have to. Not because they did anything wrong, not because they missed some obvious deadline, but because there are specific charges built into how Medicare works in 2026 that most people simply don't know to look for. And when you don't know they exist, you can't fight them. That's what this video is about. 3 hidden charges that are quietly draining money out of Medicare beneficiaries this year. Some of these affect Part B premiums. Some involve Medicare Advantage. One of them could affect you even if you think you have great coverage, and none of them are widely discussed in the ways they should be. If you're new here, welcome to OG John Hub. This channel is dedicated to helping Americans understand retirement, Medicare, Social Security, investing, and personal finance in plain, honest language. No jargon, no fine print deliberately skipped, just the information you need to make better decisions. If that sounds valuable to you, subscribe now and turn on notifications. We put out new videos regularly, and this is exactly the kind of content you'll want to stay ahead of. Now let me set the stage for what's really happening here. Medicare is not simple. It never has been. It's a system built across decades, updated constantly, and administered with a level of complexity that even trained insurance professionals sometimes struggle to navigate. For the average retiree who's just trying to stay healthy and keep costs manageable, the system can feel overwhelming. And that complexity is exactly where these charges hide, not because anyone is hiding them intentionally, but because they exist in corners of the rules that most people simply never explore. Let's start with the first one, and this one surprises people every single time it comes up. If your income was above a certain threshold in prior years, Medicare doesn't just charge you the standard Part B premium, it charges you more. This extra charge is called IRMAA, the Income-Related Monthly Adjustment Amount, and in 2026, the income brackets that trigger IRMAA are still catching people off guard. Here's why this matters more than most people realize. IRMAA is calculated using your tax return from 2 years prior, so the premium surcharge you're paying in 2026 is based on what you earned in 2024. For people who had a high-income year in 2024, maybe they sold a home, took a large IRA withdrawal, had a business transaction, received a one-time distribution, they may now be paying hundreds of dollars more per month for their Medicare Part B and even Part D coverage without fully understanding why. The standard Part B premium in 2026 sits at a base level, but beneficiaries who hit certain income thresholds can end up paying significantly more, and for higher income individuals or couples, that surcharge can add up to thousands of dollars annually. Now here's what most people don't know. If your income has genuinely dropped since that 2-year-old tax return, because you've retired, reduced your hours, or had a life-changing event like the death of a spouse, you can appeal your IRMAA surcharge. Medicare calls this a life-changing event appeal. You fill out a form, provide documentation, and request that Social Security use a more recent tax year. Many people who qualify for this relief simply never file for it. They see the higher premium, assume it's just how Medicare works, and move on. That's money left on the table every single month. So if your income dropped significantly between 2024 and 2026, that is the first thing you should check today. Pull up your Medicare statement, look at what you're being charged for Part B, compare it to what the standard premium is for people in the lowest income bracket, and if there's a gap, find out why. You may have grounds to appeal, but IRMAA is just the beginning. The second hidden charge is one that trips up people who are enrolled in Medicare Advantage, and it's more subtle. Medicare Advantage plans, the private insurance alternative to original Medicare, are popular for a reason. Many of them come with low or even $0 monthly premiums, dental, vision, and hearing coverage, prescription drug plans bundled in. On the surface, they look like an incredible deal, and sometimes they are, but there is a cost dynamic inside Medicare Advantage that millions of beneficiaries don't fully understand until they're already in it. It's called cost-sharing creep, and it works like this. Every year, Medicare Advantage plans can adjust their cost-sharing structures. That means your copays for specialist visits, your coinsurance percentages for hospital stays, your out-of-pocket limits, and your drug tier structures can all change from one year to the next, and they often do. You get a notice in the fall during annual enrollment period. It arrives in an envelope that looks like routine mail. Many people set it aside or glance at it without reading the actual changes. Then in January, they start using their plan the same way they used it last year, and the bills come back different. A specialist visit that cost $25 last year now costs $50. A drug that was in Tier 2 is now in Tier 3. A procedure that was covered at 90% coinsurance is now at 80%. None of these changes are illegal. They're disclosed in that annual notice. But if you didn't read it carefully, you had no idea the ground shifted under you. This is why Medicare Advantage experts consistently encourage beneficiaries to review their plan's annual notice of change every single year during the fall enrollment window, not just skim it. Actually read the sections that affect the care you use most. If you take 3 medications, look up all 3 on the new formulary. If you see a cardiologist twice a year, find out what that visit costs under the new terms. That 15-minute review could save you hundreds of dollars in unexpected charges in the coming year. And here is the detail most people miss on this one. If your Medicare Advantage plan has raised its cost sharing in ways that now make it more expensive than original Medicare for your specific health needs, the annual enrollment period is your window to switch back. You are not locked in forever, but you have to act in that window. Once it closes, your options narrow significantly until the next cycle. Now let's talk about the third hidden charge. This one is sneaky because it doesn't look like a charge at all at first glance. It's the Medicare Part D coverage gap. And while the Inflation Reduction Act made major changes to how the coverage gap works, the new structure in 2026 still has features that can catch people off guard in ways they didn't anticipate. Here's the reality. Drug costs in Part D don't flow linearly. There are phases to how much you pay throughout the year, and the transitions between phases don't always happen at predictable times for every person. Some beneficiaries hit the catastrophic phase relatively early in the year if they have high drug costs. Others stay in the initial coverage phase all year. But the confusion comes from people who don't understand where they are in the structure at any given moment, and therefore don't anticipate a cost spike. Beyond the coverage gap mechanics, there's another Part D issue hiding in plain sight. It's called the Part D late enrollment penalty. If you went without creditable prescription drug coverage for 63 or more consecutive days after first becoming eligible for Medicare, Medicare adds a permanent penalty to your Part D premium, and that word permanent is critical. It doesn't go away after a year. It doesn't phase out. As long as you have Part D, you pay it. The penalty accumulates based on how many months you went without coverage, and for some people who didn't enroll in Part D because they didn't think they needed it, maybe they were healthy, maybe they took few medications, that decision years ago is still adding money to their monthly bill today. Now you might be thinking, I can't undo a late enrollment penalty if I already have one. And you're right, generally speaking. But what you can do is make sure you're not accumulating more penalty time, and you can verify that the penalty you were assessed was actually calculated correctly. Errors happen. People who had employer coverage or other creditable coverage sometimes get penalized anyway, because the paperwork didn't transfer properly. If you have a late enrollment penalty and you believe you had creditable coverage during the period in question, it's worth requesting a formal review. So let's bring these 3 things together, because that's where the real picture forms. You have IRMAA surcharges that many people are overpaying because they haven't filed a life-changing event appeal after a drop in income. You have Medicare Advantage cost-sharing changes that quietly raised costs between last year and this year for beneficiaries who didn't scrutinize their annual notice of change. And you have Part D penalties and coverage phase transitions that are adding costs in ways that feel invisible until the bills arrive. None of these are exotic problems. They affect everyday people, people who worked hard their whole lives, planned as well as they could, and chose Medicare coverage in good faith. The problem isn't that the system is corrupt. The problem is that the system is complicated, and complexity has a cost when you're not equipped to navigate it. What can you actually do about this? There are a few practical steps worth taking today. Pull your current Medicare statement and confirm exactly what you're paying for Part B. Compare it to the publicly posted standard premium. If yours is higher, find out if it's IRMAA and whether you have grounds for a life-changing event appeal based on reduced income. The form you're looking for is SSA 44. It's available directly from the Social Security Administration. If you have Medicare Advantage, dig out your annual notice of change from last fall. If you can't find it, call your plan and ask them to walk you through your current copays and coinsurance for the services you use most. Compare those to what you paid last year. You may find the plan has shifted in ways that are costing you more than you realized. If you have Part D, check whether you have a late enrollment penalty on your statement. If you do, and you believe you had creditable drug coverage during the gap period, contact Medicare or your state health insurance assistance program, known as SHIP, to request a review. SHIP counselors are free, trained, and available in every state. The broader lesson here is one that retirement financial planning teaches over and over again. The people who preserve their money most effectively in retirement aren't necessarily the ones who made the most money. They're the ones who paid close attention to where their money was going. Medicare isn't free, even when it feels like a benefit. Understanding exactly what you're paying and why is not optional. It's part of the job of being a smart retiree. Retirement should be a time of peace, not a time of financial anxiety. The goal of knowing this information isn't to feel overwhelmed, it's to feel in control. When you understand how these charges work, you can ask the right questions, file the right forms, and make the right decisions during enrollment windows. That's financial confidence, and that's what this channel exists to help you build. Thank you for spending time with us here on OG John Hub. If you found this video helpful, leave a comment below and let us know which of these 3 charges surprised you most, or whether you've dealt with any of them yourself. Your experience might help someone else who's watching. And if you know a family member or friend who's on Medicare in 2026, share this video with them. Something in here might save them real money this year. We'll see you in the next one.